Hello everyone and welcome back to the sessions on strategic financial management. Now friends, in this class of strategic financial management, we are beginning with again a very important topic. You can call this topic as interest rate risk management, that is classified as this title as per ICAI study material as well as ICAI syllabus, and the same is given in CMA Institute study material in the topic derivatives itself. So basically I would prefer calling this topic as neither of these. I'll better call it as interest rate derivatives. So this is part of derivatives itself when we try to create contracts where the underlying is an interest rate. So let me explain one thing. There is a lot to do with interest rates, and because of interest rate fluctuation also risk arises on the entity, correct? For example, suppose you have borrowed money at a fixed rate and in the market you find that the interest rates have started declining, but because you borrowed at fixed rate, what will happen? You are paying interest at a higher rate and in the market the interest rates have declined. Your bank is charging a penalty for these change of interest rate arrangement. If you try to renegotiate from your bank, they will charge some kind of penalty, some kind of charge they will put upon you. So basically, because of fluctuation of interest rate also, whether the entity is an investor or a borrower or any type of entity which is dealing with any kind of loan or advances or investments, it will have risk of changes in interest rate. So our whole objective is interest rate risk management, and the instruments which we are going to use for managing the interest rate risk are called as interest rate derivatives. So that calls us to discuss concept number 1 within this chapter, which is also titled as interest rate derivatives. So I am telling you one thing again, interest rate risk management, if I mention that topic title, it is kind of, we are trying to convey what is our objective, interest rate risk management. How would you do that? That is titled as interest rate derivatives. So CA and CMA students, please be careful. In your respective study materials, this is classified as a separate chapter for CA students, and this is classified as the component of derivative chapter itself for CMA students. Now, when we talk about interest rate derivatives, let us first try to understand what are these interest rate derivatives. Interest rate derivatives are typically derivatives only, but the underlying over here, the underlying component over here is not a share, it is not a currency, it is not a commodity, it is not an index. The underlying over here is an interest rate. So you might be wondering, sir, how can interest rate become an underlying? Let me give you one simplest example. Suppose I want to borrow from a bank, and being a borrower, I will always have a fear of rising interest rates. So I approach a banker and ask for interest rate what they would charge if I borrow a sum of rupees maybe 10 lakhs. So the bank is quoting, suppose, interest rate of 12% per annum. Then I convey to the bank that fine, 12% is agreeable by me, no problem, I can borrow at 12%. However, I don't want to borrow now, I want to borrow after 6 months, and I want to borrow for a period of 1 year, or I want to borrow for a period of 5 years, but I want to borrow not now, after 6 months. My borrowings will begin after 6 months. So you please provide me a rate which will be applicable for the borrowing that will be after 6 months. If you can commit me that you will lend me money at 12% even after 6 months, I would want to sign a contract with you so that the rate is frozen you will charge 12% interest rate irrespective of the actual rate of interest prevailing in the market at that time. That is after 6 months when I intend to borrow. Suppose the banker agrees. Banker agrees and says, yes, even after 6 months when you have to borrow, we will charge 12%, and they are ready to enter into a contract. So there is an agreement between me as a borrower and the bank as a money lender. There is an agreement, and it is not an agreement for spot borrowing. It is an agreement for a forward borrowing, because borrowing will initiate after 6 months. So if the borrowings are to initiate after 6 months, it is an agreement of borrowing, and it is a forward agreement because the borrowings are to commence after 6 months from the date of signing the contract, but the interest rate has been negotiated and contracted and included in that contract right today. Then such a contract is a derivative, and because the underlying over there is an interest rate, it is called interest rate derivative. In fact, to be more specific, I gave you an example of FRA, that is forward rate agreement. So forward rate agreements are most popular form of interest rate derivatives. However, there can be different types of interest rate derivatives like forward rate agreement. There can be interest rate guarantee contracts. There can be interest rate futures, interest rate options, interest rate swaps. There can be swaption contracts. There can be lots of instruments where these are all derivatives, and the underlying over there will be not anything else but interest rate. So friends, what we are going to do, we are going to first write a little bit of notes about interest rate derivatives, and then I'll start discussing each instrument in interest rate derivatives at length as and when the right time comes. So first over here what we do is we just begin with writing some notes, and first you write classification of interest rate derivative. Number 1, forward rate agreement, FRA, interest rate futures, IRF, interest rate options, IRO, caps, floors and collars, interest rate swaps and swaptions. Let us move ahead and now talk about concept number 2, that is forward rate agreement. So while getting started with the meaning of interest rate derivatives, I already gave you an example about forward rate agreement. Yes, some time back, the example that I gave you, that I wanted to borrow from a bank, not today but after 6 months, that kind of agreement if I am having with the bank, that kind of agreement is a forward rate agreement. It is an agreement to borrow at a future date, at a future defined date, but at an interest rate which is agreed today. So what happens exactly when you talk about entering into a contract with bank for borrowing at a later date but fixing an interest rate today? It is typically a forward rate agreement. So many a times you would have seen forward rate agreement, they are styled in terms of time. For example, you would have seen 6/9 FRA. 6/9 FRA. Now, if I simply say 6/9 FRA, you should know how to interpret it. Okay. So basically, it is in terms of months. So 6/9. So it is 6 months and 9 months. So how do you interpret 6/9 FRA? 6/9 FRA is interpreted as the borrowing will initiate after 6 months and the borrowing will end after 9 months. Both of these periods, 6 months and 9 months, are counted from today's date. That means I will borrow after 6 months and I'll borrow only for an incremental period of 3 months. That means borrowing period will be only 3 months. So some people tell me that, sir, why don't we call it 6/3 FRA, that I'll borrow after 6 months for a period of 3 months. That is not how it is styled. The style of mentioning a forward agreement, if it is written as 6/9 FRA, how should you interpret that? 6/9 FRA means I will borrow after 6 months for a period of 3 months. That means borrowings will initiate at end of 6 months from now and borrowings will terminate at end of 9 months from now. So 6 months from now and 9 months from now. If you look into that block period of the borrowing, it is from end of 6th month to end of 9th month. and both of these are counted from today's date. So what was the borrowing period? Borrowing period was just 3 months. Let us take more examples to have much better understanding. If it is 3/9 FRA, how would you interpret? Think, you're watching this video, think on how would you interpret 3/9 FRA. You would say that we will borrow after 3 months for a period of 6 months, because borrowings will initiate after 3 months from now and borrowings will terminate after 9 months from now. So borrowing period will be 6 months. So how would you interpret that 3/9 FRA? I will borrow after 3 months for a period of 6 months. So how would you interpret 3/12 FRA? That I will borrow after 3 months for a period of 9 months. Why? Because borrowings will initiate after 3 months from now and borrowings will terminate after 12 months from now. So the borrowing period will be 9 months. So if I write 6/12 FRA, that means I will borrow after 6 months for a period of 6 months, because the borrowings will initiate after 6 months from now and the borrowings will terminate after 12 months from now. So when we talk about FRA, most important thing over here is to understand the meaning of FRA, and then the most important thing will be determining FRA rates, which is going to be our next point of discussion. So I'm not going to put that point right over here. Let me first give you some important note about what exactly is FRA. So FRA is a contract that allows an entity to borrow or invest a certain amount of money at a certain specified date in future at an interest rate agreed today. For example, X Limited enters into FRA with IDBI Bank on 1/4/2021 that it shall borrow from the bank at the rate of 12.5% per annum interest on 1/10/2021. So look into one thing, the date on which this agreement is signed, that is the agreement date is 1/4/2021, and the borrowings will initiate from 1/10/2021. That means the borrowings will start after 6 months from the date of contract. So the borrowings will terminate at which date, that they haven't given. Otherwise, I would have mentioned the style in which you write this kind of FRA. Anyway, let us move ahead and now talk about concept number 3, determining forward rates. So as I told you, after understanding the meaning of what is an FRA, that is what is forward rate agreement, you should then learn how to determine forward rates. So determining forward rates is our next very important task. Now instead of just talking like that, we will prefer taking an example which is given in question number 3. Let us first read this question. It says, consider the following. 6-month borrowing rate is 11.2% per annum and 12-month borrowing rate is 12.2% per annum. What should be 6-month FRA rate at 6 month forward, that is 6/12 FRA. So what is the question trying to inform you? They are informing you that if you borrow for a period of 6 months from now, the rate will be 11.2% per annum. If you borrow for a period of 12 months from now, the interest rate will be 12.2% per annum. So what is your objective over here? Your objective is to consider these two rates, and through these two rates you should be able to arrive at what would be the rate for borrowing after 6 months for a period of 6 months. You remember some time back when I was explaining how would you interpret 6/12 FRA rate. How do you interpret 6/12 FRA? It will be that I will be borrowing after 6 months for a period of 6 months. Why? Because the borrowings will initiate after 6 months from now and the borrowings will terminate after 12 months from now. So the borrowing period will be initiating after 6 months from now and terminating after 12 months from now. So the borrowing period will be 6 months, that is from end of 6th month to end of 12 months. That is how we interpret 6/12 FRA. So the idea about how to interpret a given FRA, that you have understood. What is most important thing in this question? How would you determine the FRA rate? That means if you want to borrow after 6 months from now for a period of 6 months, how would you determine what will be the applicable rate, or what should be the applicable rate for such borrowing? Now, this calculation in your institute study material is given by application of a formula. If you keep applying formula without understanding the core logic behind that, it is madness. So what I'll do is, if a question like this comes in exams, you can use formula. I'm not against using formula, but you should at least understand the logic behind that formula. So what I'll do is, I'll solve this question 2 times. First by formula, where you will find that the way ICAI is presenting the solution in its material, you have just applied that. Then I'll make you solve the question logically, and believe me, when you logically understand, you won't feel like using that formula. In fact, you will prefer solving the question logically. So if you want to do it that way, absolutely no prohibition, you can do like that. There is no compulsion that you use formula. But what will happen, if you go logically, you will have to write a descriptive answer and it may take little longer time. So quicker thing would be to use the formula and get the answer. So I'm anyway going to show you solution both the ways. So let us waste no further time and try to understand how to solve this particular question. So when you put up a solution, you would first write up a formula, that is FRA rate equals to R2 into T2 minus R1 into T1 whole upon 1 plus R1 into T1 into T2 minus T1. So now obviously you might wonder what are all these variables for. So let me explain you each of these variables. R2 and T2. 2 here represents the longer time. Longer time was 12 months, correct? So R2, this is the rate of interest applicable for borrowing of 12 months, and T2 is the longer period of time, that is 12 months. R1 is the rate of interest applicable for a 6-month borrowing, and T1 is the shorter period of borrowing, that is 6 months. So R2 in our example is 12.2%, T2 is 12 months, R1 is 11.2%, T1 is 6 months. Just be careful about one thing, T1 and T2, which are representing the time frames, we should not write it as 6 and 12, we should write it as 0.5 and 1, because we have to write up T over here as time in years. So R2 will be 12.2%, T2 will be 1 year, R1 will be 11.2%, T1 will be 0.5 year. In the denominator we again have the same variables, so I don't have to again explain what are these variables standing for. So let us substitute the values of these variables over here. R2 12.2% written as 0.122, T2 1 year written simply as 1, minus sign, and then within brackets R1 into T1. R1 was 11.2% expressed as 0.112, T1 is half year, that is 0.5. Thereafter whole upon 1 plus R1 into T1. So 1 plus 0.112 into 0.5, and finally this last part within brackets T2 minus T1, that is 1 minus 0.5. Now what you do, in the numerator 0.122 into 1 will give you 0.122 as it is, and 0.112 into 0.5 you should get 0.056. In the denominator this part will still be 0.056, and added 1 to that it will be 1.056, and this part will be 1 minus 0.5, that will be 0.5. So when you apply the calculations, it is 0.122 minus 0.056 divided by 1.056 into 0.5, and when you make these calculations what you get is 0.066 divided by 0.528, and when you make that calculation finally what you get is 0.125 or 12.5% per annum. This is the FRA rate. let us now move ahead and determine this FRA rate logically. Assume that you are going to borrow rupees 1 lakh for a period of 6 months only. So if you borrow 1 lakh for a period of 6 months, what will be the final amount that you have to pay back with interest? So you have borrowed 1 lakh for a period of 6 months. Obviously the applicable rate will be 11.2% per annum as given in the question. So let us work out the maturity value. So it will be 1 lakh into 11.2% into 6 by 12, that will be the interest amount. When added to the principal, the maturity value comes to 1,05,600. That means if you borrow 1 lakh for a period of 6 months at this rate of 11.2% per annum, it would become 1,05,600. However, if you borrow 1 lakh for a little longer period, that is for a period of 12 months, the applicable interest rate is 12.2% per annum, and that is applicable for 12 months, correct? Now, what would be the maturity value or the future value of this 1 lakh? If 1 lakh is borrowed at 12.2% for 12 months, it will be having maturity value of 1,12,200. Do you understand one thing? That both of these values are the present values, and this is the future value after 6 months, and this is the future value after 12 months from now. So, if you would want to borrow after 6 months, the value after 6 months is 1,05,600, and we don't know at what interest rate, but we know that this amount after another 6 months would get a maturity value of 1,12,200. So we have 3 different values, right? Current value of 1 lakh, value after 6 months 1,05,600, current value of 1 lakh, value after 12 months 1,12,200. So if the value is 1,05,600 after 6 months, at some interest rate for 6 months, it would become 1,12,200. So simply you have to answer the question mark value over here. So in simple words, if you borrow 1,05,600 after 6 months for a period of 6 months, the maturity value of that borrowing must be 1,12,200. So you just have to find that rate of interest. Now how would you do that? Simple logic is P1 minus P0 divided by P0. So the question mark value will be 1,12,200 minus 1,05,600 divided by 1,05,600. That will be the interest rate, but that interest rate will be for 6 months. To convert that into per annum, we would multiply by 12 by 6, and you can use your calculator and check it. It will be exactly 12.5% per annum. Now, whether the case is of borrowing or investment, it does not make any difference at all. You can still make the calculation of FRA rate in the same way. Let me now explain you from investment viewpoint. Okay, though the question is giving from borrowing viewpoint, it does not matter. As I said, you can take it from investment angle. For example, if you invest rupees 1 lakh today for a period of 6 months at this interest rate, this is the maturity value that you will obtain after 6 months. You know how we have computed this, right? It is 1 lakh into 11.2% into 6 by 12, and that would give you the interest amount. Interest added to principal, it will become maturity value of 1,05,600. If you invest 1 lakh for a period of 12 months, it would become 1,12,200 at 12.2% per annum. That means this is the future value of 1 lakh after 6 months from now, and this is the future value of 1 lakh after 12 months from now. So both of these in terms of future value are at parity. That means this future value, which is a value after 6 months, must become 1,12,200 after another 6 months. That means if you invest 1,05,600 for a period of 6 months, after 6 months from now, at some interest rate, it would become 1,12,200. So what should be that interest rate?
That is what we have logically calculated over here. So friends, in examination, if you just write up these calculations, you will not be rewarded marks. You have to then write some description. Those descriptions I am going to provide you definitely. You can write a descriptive answer. There is no mandate on using the formula, but by using the formula, your calculations become quicker. So let me show you those descriptions. You write even that description and then you can decide what approach you would want to follow ahead. So that description part comes this way. If rupees 1 lakh deposited now, once again I have taken the viewpoint of depositing now. Okay, you can write it borrowers also, no problem. So if rupees 1 lakh deposited now at 11.2% per annum for 6 months, the resulting maturity value will be rupees 1,05,600. I have shown the working how we got 1,05,600. If rupees 1 lakh deposited now at 12.2% per annum for 12 months, the resulting maturity value will be 1,12,200. It is implied that after 6 months from now, if rupees 1,05,600 is deposited for 6 months, the resulting maturity value must be 1,12,200. That is why we then relate this and this value, and this is P1, this is P0. So P1 minus P0 divided by P0 would give you the interest rate applicable for that 6-month period after 6 months from now. And by calculation, we have already logically seen that it comes to 12.5% per annum.
Let us move ahead and take up the next question. That will be question number 4. Let us read this question.
It says, consider the following. 3-month borrowing rate is given as 11.2% per annum and 6-month borrowing rate is given as 12% per annum. What should be 3-month FRA rate at 3 months forward, that is 3/6 FRA? Friends, never forget how to interpret this line of 3/6 FRA. 3/6 FRA means you would want to borrow or invest after 3 months from now and for a period of 3 months only. That means your borrowing or investment begins after 3 months and ends after 6 months from now. So your period of borrowing or investment will be just for 3 months only. So how do you solve this? We write up the same formula, correct? FRA rate equals to R2 into T2 minus R1 into T1 whole upon 1 plus R1 into T1 into T2 minus T1. Same way, the way we have done earlier, we are going to substitute all the values of variables over here, and when we make the calculations, we would get that interest rate as 12.45% per annum. Now do one thing. After this, we would write up the logic behind this calculation and we would logically determine this 12.45%. In the same way as we did earlier, same way consider a sum of rupees 1 lakh that we would want to borrow today for a period of 3 months only. So now pick your calculator. Consider 1 lakh as the principal amount, rate of interest as 11.2% and consider that as 3 months time. So it will be 1 lakh into 11.2% into 3/12. Check what is the interest amount you are getting. Add that interest to this principal amount of 1 lakh and tell me what comes as the maturity value. Obviously, your answer of maturity value should be 1,02,800. Now again take that same 1 lakh and now borrow it for a period of 6 months, a longer period, and for that the applicable rate is given as 12% per annum, correct? So if you are borrowing 1 lakh for a period of 6 months at the rate of 12% per annum, how would you compute the interest? 1 lakh into 12% into 6/12, correct? And that would give you maturity value of 1 lakh plus 6,000, that is 1,06,000. So if this is the maturity value of borrowing after 3 months and this is the maturity value of the borrowing after 6 months, that means it is implied that if after 6 months you borrow this sum, that is 1,02,800 for a period of next 3 months at some interest rate, its maturity value should be 1,06,000. Now same thing, find the value of this question mark. So this is considered as P1, this is P0. So P1 minus P0 divided by P0. So The question mark value will be the FRA interest rate. So FRA rate this time, and this time because what you are computing is for 3 months, we want a per annum rate. The fraction of time that we have multiplied over here is 12 by 3, and this you get obviously as 12.45% per annum. So whether the case is of borrowing or a case of making a deposit, the logic remains same, the answer will be same. So let me give you description by taking the viewpoint of making a deposit. So if rupees 1 lakh deposited now at 11.2% per annum for 3 months, the resulting maturity value will be rupees 1,02,800. And how we got 1,02,800 we have written. Similarly, if it is for 6 months, the maturity value will be 1,06,000 with interest rate of 12% per annum. And finally, you can write that it is implied that after 3 months, the value of 1,02,800 will be matching with the value of 1,06,000 after 6 months. That means if after 3 months you deposit 1,02,800 for a period of 3 months, it should become 1,06,000. So logically you just have to find the interest rate between those two values.
Let us move ahead and take up the next question, that will be question number 5. Let us read this question.
It says consider the following. 3-month borrowing rate is 11.2% per annum. 3-month FRA rate at 3 month forward, that is 3 by 6 FRA is 12% per annum. What should be 6-month borrowing rate? Now see, this time they have given you 3-month borrowing rate, they have given you 3-month FRA rate for 3 month forward, that means 3 by 6 FRA is also given. You have to determine the interest rate that will be applicable for a 6-month borrowing period. So now this is going to be very simple. What we do is, if we borrow 1 lakh today for 3 months, the interest rate will be 11.2% per annum, and that will have maturity value of 1,02,800. And using 3 by 6 FRA rate, we can say if after 3 months you are borrowing 1,02,800, its maturity value will be 1,05,884. Let me explain how we got this value. This is the amount borrowed after 3 months at 12% per annum, because 12% is the FRA rate given, correct? So it will be 1,02,800 into 12% into 3 by 12. Whatever interest you get, add that to 1,02,800, and what you will get is the maturity value of 1,05,884. In simple words, if you are borrowing 1 lakh today, the maturity value after 6 months, 3 plus 3, 6 months, should be 1,05,884. Same value, okay? So we don't know what is the interest rate prevailing for this 6 months time. So simple again, this is P1, this is P0, P1 minus P0 divided by P0. So that will be 1,05,884 minus 1 lakh divided by 1 lakh. And because this will be the interest for 6 months, to annualize it, in other words to convert it into a per annum rate, we multiply by the time factor of 12 by 6, and what we get is 11.768% per annum.
Let us move ahead and now discuss concept number 4, that is speculation and hedging through FRA. So the question is, can we use forward rate agreement for the purpose of speculation as well as hedging? The answer is definitely yes. So hedging can be very clearly understood, because if you have entered into a forward rate agreement and the forward rate has already been decided, so you have already learned one thing, that you will be able to borrow or invest your money at the defined rate, that is the FRA rate, irrespective of the interest rate that will prevail in the market at the date of borrowing or investing. So FRA definitely provides you complete opportunity for hedging. So that is understandable. However, how would you identify that FRA can also be used for speculative purpose? And the fundamental question is, can we speculate through FRA? The answer is yes, it is possible that you can speculate through FRA. So what may happen, suppose you have sentiments that the interest rate might rise up, correct? Or you may have sentiments that interest rates may fall, and you want to take advantage of this expectation that you have in your mind. If you want to do that and you want to make a speculative gain, it is definitely possible. So what I'm going to do is I'm going to take up an example to explain you this whole thing, that is how to speculate through FRA. This example is one of the question given in your textbook, but over here the example conveys a lot of conceptual matters, and therefore I would want you to write that example even though it is given in your book, but I am requesting you all to please write up that example systematically. This example will convey to you how to approach a speculative FRA situation, so that you know you will be able to logically understand how to determine that kind of speculative gain or speculative loss as the case may be. And instead of just mugging up and applying formulas, you should be able to logically make that calculation. So I want you to just concentrate on this example.
You expect that interest rate will rise up in coming 3 months and want to take advantage of this rising interest rate. For this purpose, you should buy FRA contract that will be effective after 3 months from now. So buying an FRA means what? So let us clarify. Buying FRA would imply that you agree to borrow at the FRA rate. That is the typical meaning of buying an FRA. So if you want to invest at FRA rate, you would be selling an FRA. Here we are buying an FRA means we are willing to borrow. Let us move ahead and now take up some more calculative content. Assume that you wish to borrow rupees 1 lakh after 3 months for a period of 6 months. So FRA contract will allow you to borrow at contracted FRA rate irrespective of interest rate prevailing after 3 months. 6-month FRA rate at 3 month forward, that is 3/9 FRA. So understand, it is 6-month FRA rate at 3 month forward. That means you would want to borrow after 3 months for a period of 6 months. So we generally call it as 3/9 FRA, is quoted by bank at 12% per annum. Assume that after 3 months the interest rate prevailing in the market is 13.2%. Determine the amount of gain made by buying this FRA. Let us now first put up a formula and work out the settlement amount using that formula. So as per the formula, the settlement amount is N into RR minus FR into T divided by 1 plus RR into T. Let us define the variables. N stands for notional principal, RR is the reference rate, FR is the FRA rate, and T is time in years. When you substitute all these values, the notional amount of loan was 1 lakh. RR is the reference rate. Reference rate is the actual rate that prevails when the period of borrowing begins. That was 13.2%. And FR stands for the FRA rate that you have agreed with the bank, that was 12% per annum. And this 6/12 is the time for your borrowing, right? 6 months, 6/12. Time will be expressed in years, that is why it is 6/12. And then 1 plus RR into T, 1 plus reference rate into time. So friends, what you do is you work out this calculation and you will find it is in the numerator 600 divided by, in the denominator, 1.066, and that works out to rupees 562.85. Now friends, nobody will ever understand what calculation this is and what is the logic behind all this calculation. You will not follow at all, because this is just a formula based working. Now in examination, I would strongly recommend you to follow this formula based approach. It will save a lot of your time. But in the class, you should learn the entire logic behind this whole calculation. Now let us go into the core logic of this. Okay, please carefully first understand. I'll then give you time to write. So after 3 months, you would want to borrow 1 lakh for a period of 6 months. And the agreed FRA rate with the bank was 12% per annum. That means you would pay rupees 1,06,000 on maturity. So you are borrowing 1 lakh and you will repay 1,06,000, correct? Now after 3 months, if you would have borrowed 1 lakh, without the FRA contract. This 1 lakh if you would have borrowed without FRA, do you think you would have obtained 12% opportunity? Answer is no. In that case, you will not pay interest at 12%. You will pay interest at what rate? You will pay interest at 13.2% per annum, correct? If you are going to pay interest at 13.2% per annum, obviously you are going to pay more amount on maturity. So you are going to pay 1,06,600. I'm sure you understand this. Because of FRA, if you borrow 1 lakh, you would repay 1,06,000. Without FRA, if you borrow 1 lakh, you would have repaid 1,06,600. So basically, what is the gain resulting on termination, that is after 6 months? So after 6 months, because of FRA, you have made a net saving of rupees 600. Are you following the simple calculation? Now, if this is the gain, when is this gain going to arise? It is after the borrowing is completed, right? Because interest is payable always at the end. If interest is payable at the end, this 600 of gain you are making at the end of 6 months. Let us do one thing. Let us simply compute the present value of this 600. So present value of this gain would be 600 divided by 1 plus I. For considering the interest rate for determining present value, we will consider whatever is the prevailing rate in the market, and prevailing rate in the market is 13.2% per annum. If it is 13.2% per annum, that is for 1 year, for 6 months it will be half of this, and half of this is 6.6%. So what you do is, this 600 you divide by 1 plus interest rate, and for 6 month effective interest rate will be 6.6%. So the present value of your gain will be 600 divided by 1 plus interest rate, that is 1 plus 6.6%, or simply 1 plus 0.66 or 1.066, and when you compute that, you get exactly 562.85. Under speculative FRA contract that will be effective after 3 months from now, you will simply receive the present value, that is 562.85, from the counterparty. Now friends, what you find on screen is the simple logic behind that settlement amount formula. This is what I want you to understand, and friends, this thing you have to revise it very well today without fail, because in exam we are not going to write everything in details like this. We will be better off by using the formula, but you should definitely know this logic what we have discussed.
Let us move ahead and take up a question for practicing this type. That will be question number 7. Let us read this question.
Messrs. Parker and Company is contemplating to borrow an amount of rupees 60 crores for a period of 3 months in the coming 6 months time from now. The current rate of interest is 9% per annum, but it may go up in 6 months time. The company wants to hedge itself against the likely increase in interest rate. The company's banker quoted an FRA at 9.3% per annum. What will be the effect of FRA and actual rate of interest cost to the company if the actual rate of interest after 6 months happens to be 9.6% per annum and 8.8% per annum? So the question has given you two possibilities. Under both the possibilities, we would want to find out the settlement amount which would indicate either the gain or a loss. So friends, please try to understand this line of the question. Company wants to borrow for a period of 3 months in coming 6 months time from now. So it will be basically 6/9 FRA, correct? So in the question, the rate of interest quoted by bank is 9%, and the reference rate at one place is given as 9.6%, and at other place it is given as 8.8%, and we have agreed to borrow at 9. So if the reference rate is 9.6%, obviously we will make gain, and if the reference rate is 8.8%, we will incur loss. So let us see how to present the solution. In the solution, we would first write up the settlement amount formula. We would define all these variables exactly the way we have seen in the earlier example, and then substitute the value of each of these variables in that formula and make the calculation and arrive at the settlement amount. This what you find is the outcome of case 1. So the case 1 results into a gain of rupees 4,39,453. Now let us move to the second case where the settlement amount formula remains the same. Okay, you just have to now substitute the different values. Basically only one value is changing, the reference rate. Other things remain same in the question, and this time it is a case of loss, and the amount of loss is rupees 7,33,855. Let us move ahead and take up one more question of this type. That will be question number 9. Let us read this question. TM FinCorp has bought a 6/9 rupees 100 crore forward rate agreement, that is FRA, at 5.25%. On the fixing date, reference rate, that is MIBOR, turns out to be as follows. So now we have MIBOR applicable for 3 months, 6 months and 9 months, and you are required to determine the profit or loss to TM FinCorp in terms of basis points and the settlement amount. Assume 360 days in a year. Now friends, this kind of speculative FRA, it's very easy. You are not dependent on my help to solve this question for you. But let us see, what is this 6/9 FRA interpreted as? Your borrowing will start after 6 months and will end after 9 months. That means borrowing is meant for a period of 3 months only. That is why when the FRA reference rate is opened up, you would take 5.5% because that is applicable for a 3-month borrowing period, correct? So after 6 months, your borrowing begins and your borrowing ends at 9th month. That means the borrowing will be for a duration of 3 months only. So FRA rate you have agreed at 5.25%, but the reference rate is 5.5%. By entering into FRA rate, you have saved 0.25%, correct? And that is, you have made benefit of 25 basis points. And then in the later part of the calculation, you compute by value what is the amount of benefit. So this is very simple. Let us see how to present the solution. So profit or loss to TM FinCorp in terms of basis point, FRA rate is 5.25%, reference rate is 5.5%, and that is for 6/9 FRA. So as reference rate is greater than FRA rate, profit will be in terms of basis points as 5.5 minus 5.25%, that will be 0.25%, or you may call it as 25 basis points. Now the settlement amount formula you have learnt. I have explained you logically the calculation, how it is to be made, and just to make the calculation quicker, you may write up this formula. You have learned this formula in the earlier session already. So let us define the variables. N is the notional principal, that is rupees 100 crores. RR is the reference rate, that is 5.5% per annum. FR is the forward rate or FRA rate, that is 5.25%. And T stands for the time remaining for maturity, or the time where the borrowing would remain outstanding. That will be for 90 days, but we will be writing the time in terms of years. That is why we will be taking time as 90 by 360 in terms of days. Now let us put the value of these variables in the settlement amount formula. You know this very well. You have been practicing this quite a lot of times. Let us work out the final calculation. What you get is profit of rupees 6,16,523. So conclusion is TM FinCorp earns a profit of rupees 6,16,523 because of this FRA. Let us move ahead and take up the next discussion, that will be concept number 5, yield curve. Now this is something really important. Let us try to understand what exactly is yield curve. Now before we start discussing about what is yield curve, let me give you some background. So this has interrelationship with bonds market.
so-called fixed income securities. Imagine an investor has invested in debt market at the early part of derivative chapter, correct? When I have explained the role of financial markets and debt market or bond market, which is a market where you invest on a long term and you generally invest at a fixed rate. So for example, you have purchased a 10-year government bond. Now 10-year government bond means from the date of issue, it will be remaining for 10 years in the hands of the investor, unless the investor would want to sell it away in between. So the entire life of the bond is 10 years. If it is suppose 7% government bond, then throughout the period of 10 years of its life, it will keep offering a coupon payment of 7% only. So if you haven't done a bonds chapter yet, you can just understand few terms. When I say coupon rate, means it is the contracted interest rate offered in that bond. So if it is 7% government bond, it means the coupon rate or the interest rate offered by that bond will be 7%. Now what happens if you become investor for such a bond? Then over the next 10 years period, the interest rate prevailing in the market, that is even in the bond market, may change, correct? Interest rate may not always remain stable, interest rate keep changing. But if it is a government bond that you have purchased, it will keep offering you a static interest payment of 7% on the face value. So if the face value of the bond is rupees 1000, you will be getting 7% of rupees 1000 throughout the life. That is, every year you will be receiving 7% of that face value. 7% of 1000 is what? Rupees 70. Every year you will be receiving rupees 70 as coupon payment. There may be a situation that after 3 years after you purchase the bond, you find that interest rate in the bond market has risen to 8%. That means now whoever is investing in bond market will now be able to earn 8% return, but you are going to earn just 7%. So one may think of, why not to sell out this bond and buy a new one with 8% coupon payment. You can do that definitely, but imagine if the bond market is providing a rate of 8%, your 7% bond will not have that much worth, and therefore the market value of such bond will decline. So you sell that bond, you will incur a loss. You hold that bond, you will still incur a loss. So what happens? It's a long maturity. Now, depending upon the maturity period of the bond, the coupon rate varies. Let me explain you this way. Suppose when the interest rate in the bond market increased from 7% to 8%, what happened? The value of your bond declined and you are stuck with that 7% bond, whereas all other investors currently are earning 8%. So you are stuck in that situation. If it was not a 10-year bond but just a 4-year bond, that means you just have a waiting period of 1 year. After 1 year you will get the redemption value, task over, then you can invest your money in a new bond which will offer you little higher coupon payments. You could have done that, and therefore the change of the market interest rate from 7% to 8% would not have affected you so adversely as you can get affected when it is a 10-year maturity bond. So longer the remaining maturity of the bond, the higher will be the degree of risk. Now, if there is a higher degree of risk, what will happen? Just imagine what will happen when there is a higher degree of risk. To compensate that higher degree of risk, the bond issuer will definitely try to offer little higher yield on that bond by offering little higher coupon payments. So instead of 7%, if it was 7.2% or 7.3%, your risk to certain extent gets compensated because of greater yield of that bond. So generally what happens in bond market, the near the maturity of the bond, the lower will be the yield of the bond. The longer maturity of the bond, there will be little higher yield of that bond. So when I talk about yield, we have two important concepts to be understood from bonds topic. So when you learn bond valuation, you will come across concept of current yield and concept of yield to maturity. By the way, I am recommending you one small point over here. After learning bonds chapter, please revisit this discussion once again, and if you have exhausted your views by then, don't worry, the concept of yield curve I have given a video on my YouTube channel as well. So it is my strong suggestion that after completing bond chapter, you revisit this discussion and you will be getting much more clarity about the concept of yield curve, because this has mixed concepts of forward rate, derivatives and the bond yield. And when I talk about bond yield, there could be two types of yield. Current yield means the yield only and only for current year. Another is a concept of yield to maturity, that if you are holding the bond now and there are 7 more years remaining for maturity, if you continue to hold the bond for entire 7-year remaining maturity, what would be the overall yield? That is called yield to maturity. So let me break down the whole point one by one in small simple segments so that yield curve is clearly understandable. So in the market, I mean in the bond market, there could be a bond with just 1 year remaining maturity. There could be a bond with 2 years remaining maturity. There could be a bond with 3 years remaining maturity. What do you think? Coupon rate offered by these bonds, do you think it will be same coupon rates or different coupon rates? The answer is obviously different coupon rates. Now what may happen? There may be two types of trend in the market, that interest rates are expected to rise or interest rates are expected to fall. I am assuming that it's a market where interest rates are expected to rise. So what will happen? Someone who is buying just a 1 year maturity bond will be taking very less risk, because risk is only for 1 year. If someone is taking 3-year maturity bond, the bondholder will be having little risk because the investment period is 3 years. 5-year maturity, little more risk. 10 years maturity, still higher risk. Higher the risk of the bond, the higher should be the compensation by the bond issuer by giving better coupon rates, and therefore the yield of the bond will be little higher when the term remaining for maturity is higher. So if I graphically plot these two relationships, on x axis if I plot the remaining term for the bond maturity, 1 year, 2 year, 3 year, 4 year, 5 years, like that, x axis indicates the remaining term to maturity. Y axis on the other side will indicate the yield rate. So the yield rate of 1 year maturity bond will be little lower, 2 years maturity bond will be little higher, 3 years maturity bond will be still higher, and so on. So if you plot it graphically, with the increase of the remaining maturity for a bond, the yield rate goes on increasing, but it will not be a static increase. It will be not giving you a straight line. It will give you, in a declining trend, the increase. That means the increase will happen but at a declining rate. So if you plot it graphically, you will not get a straight line sloping upward, you will get a curve. And when you get a curve, after a point, that curve will start bending, and beyond a point it will become almost flat, almost parallel to x-axis. So when the interrelationship between the yield rate of a bond and the remaining term to its maturity is plotted graphically, that relationship you will be finding as a curve that slopes upward, but being a curve, it will not be a straight line, it will gradually bend and become flat to the x-axis, parallel to the x-axis. So point is what? You need to understand, first of all, what is the meaning of yield curve. Secondly, you need to understand, as a student in examination, what kind of questions you will be facing. Sometimes you will have to determine the forward rate based on the yield curve information. Sometimes based on forward rate you have to determine the interest rate and arrive at the yield curve relationship. So if you are clear with the concepts, no matter what is being asked, with help of one factor informed to you, other factor you can determine definitely. The only thing what is really needed is your concept clarity. So what I'm going to do is I'm going to take one example which is given in your textbook as a question number 10, and that example again I would want you to note down that example, because just solving that question is not enough. In that example what I'm explaining, you need to understand that gradually. So before I move to that particular example, let us first write some notes about the yield curve. Let us first try to understand how this yield rate and remaining term for maturity would create an yield curve graphically. So you can see graphically on the x-axis we have taken the term. This I am just writing as term. It is basically term remaining for maturity. This y-axis indicates the yield rate offered by the bond. We are simply calling this as yield. So as we discussed some time back, the longer the remaining term for the maturity, the higher would be the yield rate offered by the bond. So what would happen if you are presenting the relationship between the term and yield rate graphically? I told you that it will be a trend moving upward, and it will not be a straight line, it will be a curve. So just understand that this curve which is indicating an yield curve. Now look into one thing. You have the remaining term for maturity. So understand this graphical presentation very well. If it is just 1 year time for remaining maturity, the bond is offering you this much yield. If it is 2 year time remaining for maturity, obviously I am talking about the other bond, it is offering you higher yield. 3 years remaining time for maturity, still higher yield. 4 years remaining time for maturity, still a higher yield. But do you see the increment in the yield rate from year 1 to year 2 is substantial, but between year 5 and year 6 it is very low. Therefore, this cannot be a straight line moving upward, it will be a curve, and beyond a point you would see, if you keep on plotting this curve ahead, it will be mostly become flattened, right? Anyway, so through this relationship, what do we conclude? The longer the term for maturity, the higher is the yield rate of the bond. Let us do one thing. Let us move ahead and talk about the characteristics that we have learned through this yield curve concept. The yield curve is a curve showing several yields or interest rates across different maturities, say 1 year, 2 years, 10 years, etc., for a similar debt contract. The curve shows the relation between the interest rate and the time remaining to maturity, known as the term of the debt. The treasury bonds or government bonds for various maturities are commonly plotted on a graph which is called yield curve, and the mathematical description of this relation are often called as term structure of interest rates. Let us move ahead and take some calculative examples where we can connect the concept of yield curve with the forward rates. Very, very important. So pay attention to this example. The yield curve indicates the following yield rates. So you have remaining maturity and yield rate. So 1 year remaining maturity, say it is 11% per annum. 2 years remaining maturity, it is 12% per annum. 3 years remaining maturity, it is 12.2% per annum. Now the example is further asking you, determine the following, that is 1/2 FRA rate, 2/3 FRA rate and 1/3 FRA rate. So friends, how to solve this I will explain you in detail, and we will write down the solution step by step. So let us see how to approach the calculation of FRA rates. I'll give you one explanation, other things you can definitely do on your own. So just focus on this 1 year remaining maturity bond. The yield rate offered by that bond is 11%, and now the 2 year bond is offering you yield rate of 12%, and the question is asking you to determine 1/2 FRA rate. I am sure you know the meaning of this 1/2 FRA rate. Now that means you would want to borrow after 1 year. You don't want to borrow now, you want to borrow after 1 year, and you would want to borrow for a period of 1 year.
here the objective of putting this in this format, that 1/2 FRA rate. So 1/2 FRA is the contract that will initiate after 1 year and will close after 2 years from now. So the period of borrowing will be only 1 year. That means the period of borrowing starts after 1 year end, and the borrowing period will end after 2 years end from now. That means the duration of the borrowing will be only 1 year. That is how we interpret 1/2 FRA rate. So friends, if you are holding the bond for 1 year, it is giving you 11% per annum. That means just for 1 year you are earning 11%. If you are holding the bond for 2 years, it is offering you 12% for both the years on compounded basis. So what would be the second year's yield if you are holding the bond for 2 years? That is what we call as 1/2 FRA rate. So let us see how to present the calculation of the same. Let us see how to present the solution. In the solution, you would first begin with determining 1/2 FRA rate. We would say let 1/2 FRA rate be I2. Why we have written I2? Because we are finding the rate for the second year, because the rate will be effective after 1 year for a period of 1 year. So the rate that will be applicable in the second year, we are symbolizing that as I2. Now how do we find this? So imagine that you are holding the bond for 2 years. The first year yield is basically only 11% in terms of the single year remaining maturity bond. But here the bond is being held for 2 years. It is a 2-year remaining maturity bond. What would be the implied rate applicable for the second year? We do not know. We have considered that as I2. So whatever money you have invested will have a future value of 1 plus 0.11. That is 1.11 becomes the future value factor for the first year, and the second year factor will be 1 plus I2. This will be matching with the compounded yield that you earn for a 2-year remaining maturity bond, which is offering you 12%. So you could see I have written 1 plus 0.12 raised to 2. Now when you solve this equation, you would eventually get the value of I2. That I2 value will be the 1/2 FRA rate. So when we solve this equation, what do we get? 1 plus I2 will be equal to this part. How we got 1.2544? It is nothing but 1.12. That is 1 plus 0.12 whole square would give you 1.2544. This 1.11 comes in the right hand side as a denominator, correct? So it is simple. This left hand side term moving to right hand side, the numerator over here would become denominator over here. You know how to solve equations, right? Now 1 plus I2 is this value. When you solve it, 1 plus I2 you get as 1.13009. So I2 will be obviously 1.13009 minus 1, that will be 0.13009, or simply 13.009%. Let us move ahead and take the second calculation, that is determining 2/3 FRA rate. Now this is going to be simple once you have learned how to do. So let the 2/3 FRA rate be I3. First of all, I would again insist that you should know the meaning of 2/3 FRA rate. You would want to borrow after 2 years for a period of 1 year, correct? You would want to borrow after 2 years. That means your borrowing will start at end of second year and your borrowing will terminate at end of third year. So your borrowing will remain outstanding only for 1 year period. That is gap between second year end and third year end. So you want to borrow after 2 years for a period of 1 year only. That means from now the third year is what your borrowing would remain outstanding. That is why the interest rate applicable for that we are mentioning as I3. So now till 2 years you are going to earn what? Obviously till 2 years you will be earning that rate which is offered by a 2-year remaining maturity bond, that will be 12% per annum. So it will be 1 plus 0.12 being 2-year period, it will be 1 plus 0.12 whole square. But if you are holding the bond with 3-year maturity, you are going to earn something during the 3rd year, and the yield rate for the 3rd year is mentioned as I3. In that case, this would obviously match with the 3-year remaining maturity bond, which was offering you 12.2% as yield rate, but for 3 years compounded value, it would be 1 plus 0.122 raised to 3. When you solve this equation, what do you get? 1 plus I3, this part will be this whole thing divided by 1 plus 0.12 whole square. So that will be equal to 1.122 raised to 3 divided by 1.12 raised to 2. When you solve this part, what you get is 1 plus I3 equals to 1.41246 divided by 1.2544, and 1 plus I3 finally comes to 1.12601. So I3 will be 1.12601 minus 1, that will be 0.12601 or 12.601%. Let us move ahead and now determine the 3rd FRA rate that was applicable for 1/3 FRA contract. So 1/3 FRA rate, let that yield rate be I, or that interest rate be I. Now what we will do now is, you should first interpret 1/3 FRA rate. 1/3 FRA rate means you are going to borrow after 1 year and your borrowing will terminate at end of 3rd year. So the duration of borrowing this time will be 2 years, and you would want to find that rate applicable for 2 years, and that rate for 2 years will be I. So 1 plus I will now be providing you the yield for 2 years, or if you are the borrower, you will have to bear that cost for 2 years on a compounding basis. So the equation sets this way: 1.11, that is 1 plus 0.11 for 1 year, into 1 plus I for 2 years. So it is 1 plus I into 1 plus I, that is 1 plus I whole square. And this part would obviously match with the yield offered by 3-year bond, that is offering 12.2%. For 3 years compounded value, it will be 1 plus 0.122 raised to 3. When you solve this equation, this side, left side, you will get 1 plus I whole square equals to this side 1.122 raised to 3 divided by 1.11. Solving this part now, so 1 plus I whole square will be 1.41246 divided by 1.11. Again, 1 plus I whole square gives you 1.272486. So if you want the value of 1 plus I, you have to take the square root of the term in right hand side. So 1 plus I would simply be square root of 1.272486. When you solve that, when you take that square root, you get the value of I as 0.12805 or 12.805%. Let us move ahead and take up another question, that will be question number 11. Let us read this question. Consider the following data for government securities. You can see one thing: face value of the 3 different government securities given to you, and their years to maturity are 1 year, 2 year and 3 year. Their current price is also given, and coupon rate offered by the bond is also given, and you have to simply compute the forward interest rate. So friends, how you are going to do, once you have learned the concept of yield curve, making the forward rate calculation is no big deal for you. Let us begin with the first part, and the first part you will have to take the first year maturity bond, that is the first bond, right? That means in the sequence you will have to start with this, followed by the second year maturity, because by then you would have got the first year rate. Through that you will find the second year rate, and through both of these information you will be finding the third year rate. So you have to begin with the bond which has remaining maturity of only 1 year. So let us see how to present the solution. In the solution, you will be finding the 3 years different rates as I1, I2 and I3. So as I said, you will take the 1 year maturity bond at the first, As per the bond valuation concept, the present value is nothing but the future value divided by 1 plus desired yield rate. And here, because it is 1 year maturity bond, the interest rate for year 1 we have taken as I1. So present value of the bond is already given as 91,500 and future cash flow will be 0 plus 1 lakh. Why this 0? Because if you see the first year bond, that is 1 year maturity bond, does not have any coupon payment being offered. So coupon payment is 0, but the redemption value will be at par, that is 1 lakh. So this future cash flow divided by 1 plus I1 gives you the present value of 91,500. By cross multiplication, you would get 1 plus I1 as 1 lakh divided by 91,500. 1 plus I1 is 1.0929. So I1 will be 0.0929 or 9.29%. Let us move ahead and deal with the 2-year maturity bond, which has the present value of 98,500. So let us first set up that equation. Let me explain you what is this. The first year, the cash flow will be only the coupon payment for the first year, which will be discounted to its present value using the first year applicable rate of 9.29%. So 10,000 coupon payment divided by 1.0929. Now in the second year you will be getting coupon payment of 10,000. Along with that you will get the redemption value of 1 lakh. So 10,000 plus 1 lakh would give you in total 1,10,000 of future cash flow after 2 years. Because it is cash flow after 2 years, you would discount it for 2 years. For that, what we generally do is 1 plus I whole square. But this time we have different rates. So the first year will be 1 plus I1 and second year will be 1 plus I2. So instead of taking 1 plus I whole square, we would take 1 plus I1 into 1 plus I2. Now I1 was already known, that was 9.29%. So that we have placed as 1.0929, that is 1 plus I1, and 1 plus I2 is not known in terms of I2. So I2 will be obtained through this whole equation. So once you have formulated the equation correctly, solving equation is no big deal. So let us solve this equation. So 98,500 in the left hand side as it is, 10,000 divided by 1.0929 will give you 9150, and the last term is 1,10,000 divided by 1.0929 into 1 plus I2. When you move this 9150 to the left hand side, it gets subtracted, and what you will get now in the left hand side will be 89,350 equals to 1,10,000 divided by 1.0929 into 1 plus I2. Cross multiply and you get 1 plus I2 equals to 1,10,000 divided by 1.0929 into 89,350, and finally 1 plus I2 value is 1.1265. So I2 will be 0.1265 or 12.65%. Let us move ahead and deal with the last part, taking the 3-year maturity bond for finding the FRA rate for the third year. So this time the equation would be a little longer. The present value of the bond is given as 99,000. Its coupon rate is 10.5%. So coupon payment each year will be 10,500. And it has 3 years remaining for its maturity. So coupon payment for first year, coupon payment for second year, coupon payment for third year, and at the third year you would also receive the redemption value. So in the numerators we have taken all the cash flows in future that would arise. In the denominator, what you would do is, this first year cash flow will be discounted using the first year interest rate, that was 9.29%. Second year cash flow will be discounted by taking the multiple of the factor of the year 1 and year 2, and third year cash flow will be discounted by taking the multiple of factor of year 1, year 2 and year 3. So because year 1 and year 2 rates are known, what you would simply do is, you will take 1.0929 into 1.1265 and that will be multiplied to 1 plus I3. So I3 is the only unknown factor in this whole equation. Once you formulate this equation, you can easily solve it. So it will be 99,000, that is equal to 10,500 by 1.0929 would give you 9607. The second term, that is 10,500 divided by product of 1.0929 into 1.1265 would give you 8529. And the third term, as it is, what we have done, the multiplication of these two we have applied over here as 1.23115. That is, these two multiplied, you get 1.23115. Now, what you would do is take both of these values to the left hand side. Obviously, aggregate of these two will get subtracted from 99,000, resulting into 80,864, and this third term in the right hand side remaining as it is. Now, by cross multiplying, you would take 1 plus I3 equals to 1,10,500 divided by this 1.23115 as it is, and 80,864 gets multiplied to this 1.23115. Finally, when you solve it, you get 1 plus I3 as 1.1099, and I3 will be 0.1099 or 10.99%.
Let us move ahead and take up the next question, that will be question number 12. Let us read this question.
Two companies, ABC Limited and XYZ Limited, approached the DEF Bank for FRA, that is forward rate agreement. They want to borrow a sum of rupees 100 crores after 2 years for a period of 1 year. So understand one thing, they want to borrow after 2 years but only for a period of 1 year. The bank has calculated yield curve of both the companies as follows. So they have given yield curve for year 1, year 2 and year 3 for both the companies, and you find that the case of ABC Limited, the rates are substantially higher, and they have even given you the reasons why the rates are higher. The difference in yield curve is due to the lower credit rating of ABC Limited compared to XYZ Limited. Further, what is required? You are required to calculate the rate of interest DEF Bank would quote under 2/3 FRA using company's yield information as quoted above. So friends, the way in the earlier example we have learned how to calculate 2/3 FRA rate, exactly same thing you have to do over here. Then the later part of the question is asking you, suppose bank offers interest rate guarantee for a premium of 0.1% of the amount of loan. You are required to calculate the interest payable by XYZ Limited if interest rate in 2 years turns out to be 4.5% and second case is given as 5.5%. So friends, the second part of the question depends upon the information that you will draw from the first part. I mean the calculation that you will make in the first part. So let us first deal with the first part. And what we do is, DEF Bank will fix interest rate for 2/3 FRA after 2 years for XYZ Limited as follows. It will be 1 plus R into 1 plus 0.0420 raised to 2 equals to 1 plus 0.0448 raised to 3. Friends, it is very important for you to understand the formulation of this equation before you start solving it. So as I have explained in the earlier example, you are computing 2/3 FRA. So we have considered the rate of that FRA as R. So the first 2 years you are going to pay interest at the yield rate of 4.2%. So it will be 1 plus 0.042 raised to 2. And for the third year, the applicable rate is R, so we have multiplied 1 plus R. And obviously this would match with the yield rate of 3-year bond that will be offering 4.48% per annum. So 1 plus 0.0448 will be raised to 3 times. Now, when you solve this equation, you will get the value of R. So 1 plus R equals to 1.0448 raised to 3 divided by 1.0420 raised to 2. 1 plus R will be 1.1405 divided by 1.0858, and finally 1 plus R is 1.0504. So R will be 1.0504 minus 1, that will be 0.0504 or 5.04%. So bank will quote 5.04% for a 2/3 FRA to this company XYZ Limited. Let us move ahead and make the similar calculation for the other company, that is ABC Limited. Here it is exactly the same thing, same way. I have no explanation to offer. You know how to do it, exactly the same thing earlier. Just see, in the same style we have presented the solution as well, and what you get over here as value of R is 6.38%. So to this company ABC Limited, bank will quote a higher FRA rate, that will be 6.38%. Let us move ahead and deal with the second part of the question. Now this is going to be very simple. So there are two cases given to you where the interest rate after 2 years would be 4.5% and 5.5%, correct? And they have stated that XYZ Limited has taken an interest rate guarantee contract by paying a premium. So you remember what was the rate for XYZ Limited, correct? It was 5.04% in the first case. So what would happen if the interest rate prevailing is 4.5% and there is an interest rate guarantee contract under FRA? Obviously XYZ Limited is not going to exercise this option because the rate is substantially lower than the FRA rate offered by bank. FRA rate offered by bank was 5.04% and this prevailing rate is simply 4.5%. So in that case, what happens to the option? You simply let it lapse. What happens when it is case 2? Obviously you would exercise the option and borrow money not at 5.5% but at 5.04%. So here the option will be exercised. So let us compute the interest on 100 crores. In the first case it will be at 4.5%. In the second case it will be not at 5.5% but at 5.04%. But in either case you will have to pay premium, and premium cost was the loan amount into 0.1%. So that will be 0.1 crores in either case. So final outflow would be aggregate of interest payment plus the premium, and that will be 4.6 crores and 5.14 crores in these two cases. So you can see wherever the interest rates are lower, you don't have a commitment to unnecessarily borrow at FRA rate and your interest cost can be brought down. Where the interest rate is higher, you may exercise your interest rate guarantee option and you may eventually end up paying lesser amount in total. Otherwise you would have paid at what rate? 5.5%. So that will be end of the solution.